Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, July 16th, 2024. Welcome back to the podcast, George.
Good to be on, John.
Yeah, always good to have you. And as we often do, why don't we start the episode with an update on what's happened in the data and macro world since your last podcast, which I believe was last week. Soft CPI, certainly comes to mind, but I know there are a number of other things. Take us through that and how markets have reacted.
Absolutely, and I think in the last podcast we flagged as well as in our strategy content, something that we've been saying for quite some time, that at some point there's going to be a catch up to the shelter component, adjusting lower and being less sticky, and that's largely what happened at the CPI, which really triggered what continues to be this week like a sort of focus on rotation between value and growth stocks. A sort of idea around lower interest rates, improving cash flow for smaller to mid-sized companies, something that we've also been a main topic of ours, that the rates channel now is different. And I think that CPI really was the start of that broader move, and I think it's not over either, by the way. And I think that it's a kind of moment that we will look back in time that also kind of demarks a shift in the thinking that inflation, hopefully, can't say with 100% certainty that it's completely been addressed, but we do think that this back-to-back weakness in CPI, the super core coming in negative for twice in a row, the very low core itself, and the negative on the headline, the durable goods component of inflation collapsing to some of the worst levels on record, and just cyclical measures of inflation all falling for the last 4 months. The amount of categories that are under 4%, and there's like a massive list of just how inflation is annualizing at a very slow rate. All of this, I think, at least has created at least an environment that's conducive for just the belief that hopefully we've addressed the inflation problems, and that was the biggest news, at least for the week itself. We also had on Friday, I think, which was also important, just consumer confidence continues to kind of be on a downward trend, and really pointing to concerns amongst the households around what's the true state of the economy. And I think that resulted in higher probabilities of Fed cuts coming in, and a lot of both revisions to people's forecasts, in many ways, coming around to some of the views that we've had for many months, if not quarters, that the Fed has to at least adjust rates 75 to 100, if not more, this year, and that the curve should continue on its steepening trend. So that is what was the big news on the week. But I'd be remiss not to discuss what took place over the weekend, and with the tragic and luckily could have been worse, but the failed assassination attempt on both candidate and former President Trump. That obviously is what the markets have been focused on at the moment.
Yeah, obviously we would be remiss to not discuss that, as tragic as you mentioned. We don't talk politics here on the podcast, but the event is clearly relevant for investors. So why don't we discuss just that, George?
Yeah, absolutely. So we'll stick to how the markets have been responding since we got the news, and then how people are interpreting what it means for both the election cycle and the economy and potential future policy changes and things like that. The market opened up with with kind of a risk on type stance, both in stocks and other sort of kind of risk assets, and that has really not stopped as we kind of record here on Tuesday there's a continued bigger move push up in equity prices. But what's really glaring and interesting is the continuation of this kind of like sector rotation that I mentioned happened in one of the biggest sector rotation trades on record between large caps and small caps took place around CPI, and then again that trend has continued as we moved past the events of the weekend into this week, and so you can kind of assess that that's a view around what we're seeing also in the probability and the websites that keep track of odds on different outcomes, pricing in a greater probability that former President Trump will win the election, and that the risk even of a potential red wave or a sweep, as we should call it, where you would have both the House, Senate, and the executive go to Republicans. So like I think that sort of pricing in of the odds. Some of the early polls that are coming out are also kind of shifting towards the greater likelihood, at least at this stage, that former President Trump would win this election. So yeah, a lot of kind of risk-on type trades happening in the equity space, in rotation type trades, and then in the bond market, we're seeing, and this is also tracking very closely these odds of and probability metrics that are out there. The curve has had a decent amount of steepening as a result as well. So people are calling these as the Trump trades, curve steepeners, sector rotation within equities. And that is in full force as we see in the price action. So, the one thing which we caution, and of course, at the moment, this is what's driving the price action, but there's a long road between now until November, and a lot of things can change. We are also in the midst of the RNC, and there's a lot of excitement there as well. And so, that could shift once we get towards August. Once we see either what the DNC does, and then of course the further sort of runaway towards the election in September and October. So, a lot could change. I'm not saying that it's priced in, but we've had a pretty big move, and it's consistent with our overall house view that we do think the curve should be steeper, and that could come from both concerns about fiscal policy, even if they're not warranted, but at least if the market believes it, we have to respect that. But our view has always been predicated more on the idea that the Fed is going to cut, it's going to reshape the curve, and that will, if done, in time, as we hope they will, could avoid a much more worse outcome on the economy. But data in the U.S. has been getting softer and weaker, and if the Fed holds out for too long, it could create for a challenging time between the election and the inauguration as well. So, yeah, I feel like the markets have the right to kind of jump to these conclusions, but at the same time, there's a long road ahead of us.
Yeah, so that sort of that Trump trade, it was pretty interesting on Monday, but and like you said, the curve steepened and stocks liked it a lot, but it was kind of interesting how the market rallied back quite a bit. Today again is Tuesday, and as mentioned earlier, so you've seen a little bit of a reversal of that. So I think your sort of skepticism on looking this, like whatever we are, like 4 months out of the front of the election, skepticism on reading too much into this certainly seems warranted. Um, and George, I would just say, congrats on the view. I mean, I feel like, with the market pricing in, not so long ago, the market was pricing in maybe like 2 cuts this year. Now we're pricing in
Less than
pretty
a
good.
cut. Less.
Yeah. Yeah,
Yeah.
yeah, less than 2 cuts. Now
Yeah.
we went to pricing 2 cuts, and now we're pricing in almost three, this year. The market certainly seems to be coming to your view. But before we wrap up, and I guess I would highlight, and I guess before we wrap up, and then also before when we get to what will be a very eventful month end, the BOJ will detail its plans to reduce asset purchases, and that's always, especially sitting in another country, it's very difficult to discern what another foreign bank was doing. The devil is in the details, much like the seemingly random numbers our XV engine spits out at me. But we'll also get the next Fed meeting, the quarterly refunding announcement. What should our listeners be focused on between then and now?
Yeah, and we'll reconnect again during that, which is like a power macro week. That week is we're going to be working around the clock, covering both Asia time zones and U.S. time zones, and there's refunding at the end of that week, funding in that week, and also NFP and a lot of other things going on that week. So that's going to be big power macro week. But next week, I think it's still important. First off, we're going to, we did hear from Chair Powell earlier in the week as well. We have a number of Fed speakers this week that we have to get through, and then they're going to go into blackout come Friday. So then we're going to have a quiet week on the Fed speak front next week when we're skipping the podcast. But during that week, we will have the BED release from the BLS, which will give us some insights into, is there greater revisions? There's been that the other key theme of ours, as you know, has been the concern around that, NFP has been overinflating the true nature of job growth in the U.S. And we have that divergence between households. We've been, cataloging that for over a year now. And I think, as these sort of revision metrics come out, the BED will be an important one to watch on the 24th, next Wednesday. And then we have on Thursday, Friday, we have both GDP and the quarterly PCE comes out, which that coupled with CPI and PPI, which we already know, will give us the final look for PCE before the Fed meeting. So, it's going to be a little bit more backloaded on inflation. I mean, a lot of it is already in the price, I would argue, but still, these are market moving events. And you have that revision, which I think not enough people are focusing on. And if, our kind of view around that sort of divergence in the jobs data needs to get rectified, then I think this is the starting point. You're going to start to see these releases come from the BLS and maybe prove that jobs growth wasn't as strong, and that's explaining why the households are not feeling as robust and feeling very stretched, because maybe job growth was not as strong as the headlines have been saying for the last year.
Yeah, and that's been certainly, as you mentioned, a theme of yours for a while now. And then just for those of us who aren't total, labor and econ nerds, the BED is the business employment dynamics. And there are some complementary surveys that the Bureau of Labor Statistics does to complement the household survey and the establishment survey, which is where we get the numbers we all love, like the headline payroll number and the unemployment rate. And they will kind of give us some additional insight into the labor market. As you said, I think it sounds like you are expecting them to reveal that, perhaps the strong headline payroll growth that we've seen this cycle is perhaps overstating the strength of the labor market. Is that about right, George?
That's a great summary. Thank you, John.
I do what I can. Well, great stuff as always, George. And as you mentioned, we're going to skip next week, but we'll see you back here in a couple weeks. Thank you.
Yeah, that's great. We'll be back for Fed Week, refunding BOJ and everything else in between.
Looking forward to it. And to our listeners, if you're still not receiving George's strategy reports, do check out the MUFG Research portal at www.mufgresearch.com, where you can find all of your favorite MUFG research, as well as sign up to have it conveniently delivered to your inbox. And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.